Market hardening and dislocations have led to the rise in the formations of reciprocal insurance exchanges, particularly in catastrophe-exposed coastal states. Here to discuss a new report is David Blades, Associate Director, Industry Research and Analytics, and Alexander Wynant, Associate Analyst. And Alex, given that cat risk in coastal states are constant, what's behind the increased number of reciprocal formations at this point in time?
Yep, so there's two answers to the question. The first one is climate risk and more volatile and severe weather patterns that we're seeing with these convective storms and hurricanes. Last year in 2024, cat losses attributed to 8.7 percentage points to the overall USPC combined ratio. And those combined ratios are usually pretty tight and they only change within a few points or so. So 8.7 percentage points is actually very significant. The next part of the answer is inflation, and two different types of inflation. The first is social inflation, and that speaks to the increasingly more litigious atmosphere we're seeing in the United States. We're seeing jury award huge settlements. And then the next type of inflation is literal currency inflation. So when a big catastrophe happens, you have a lot of rebuilding costs, you have labor and materials, supply chain issues can also make that more costly. And then also when your currency inflates, your overall payout just increases because the currency has inflated. So overall, the story here is that we have elevated risk, which cause premiums to go up year over year. And if that keeps going on, then you eventually arrive at unaffordable pricing. And when you have unaffordable pricing, you have a supply and demand issue in the marketplace. And when supply and demand is not at equilibrium, then born out of that, you kind of have a need for an alternative form of risk transfer, which is what a reciprocal is.
So how do companies go about getting off the ground as it applies to initial capital and meeting capital requirements?
The big answer there are surplus notes. A lot of these reciprocal exchanges are sort of startups. So with any insurance company to operate, you need a lot of capital surplus to even begin with. Something that's very unique about surplus notes is that regulators treat them as equity. They technically count as policyholder surplus, but really they're a form of debt financing. Another interesting point about surplus notes is that the state insurance commissioner approves every part of it. They approve the issuance as well as the principal and interest payments. And then if an insurance commissioner blocks these payments, the reciprocal does not go into default. So this actually protects both the policyholder and the insurer. So overall, the purpose of these surplus notes are to satisfy the statutory surplus requirements and also ensure that policyholders are paid out before creditors. So that allows for a lot of financial flexibility, but it can also, in some cases, lead to over-reliance on these surplus notes.
David, what are some steps an AM Best analyst would take in looking at a new reciprocal formation?
Well, in analyzing reciprocals, AM Best analysts will focus on our main pillars of all of our analysis of all different types of companies. So we'll focus on balance sheet strength, operating performance, business profile, and enterprise risk management. With regards to balance sheet strength, capitalization, the strength of capitalization is the most important thing that's underpinning the overall balance sheet strength. So within our best capital adequacy model, we'll look at the premiums they're writing, loss reserves. We'll look at the utilization of reinsurance, investments, and look at all those aspects of their operations and how they impact overall capitalization. Also, with regard to reciprocals, we'll look at the accessible or non-accessible nature of their policies, and we'll also look at subscriber contributions and how steady they are and how dependent the reciprocal is on them. So again, from an overall capital perspective, as Alex mentioned, again, with a lot of them depending on surplus notes, AM Best will look at surplus notes, and we understand from a statutory perspective that they count as policyholder surplus, but we don't give them full credit or full equity credit the same kind of equity credit we might give to common equity within the overall structure. So again, those are some of the things that we think about from a balance sheet strength perspective. We also look at operating performance, and we'll look at historical and prospective going forward performance. Some reciprocals are formed and they're brought together with a historical book of business. So again, we'll give credit, or we'll look at the experience of the book of business in the past, and then we'll look at what we're seeing on a going forward basis. Again, with regards to the subscriber contributions and the fees that have to be paid to the attorneys, in fact, who are running the reciprocals and who are managing their operations through and performing the services of underwriting, claims handling, policy administration. We look at how those fees impact the underwriting ratios and the operating ratios of the reciprocals. And again, by looking at all that, it gives our analysts, a common basis to be able to look at the performance of the reciprocals in the same way that they look at any other type of an entity. So it allows for benchmarking from that standpoint. And then with regards to business profile, we'll look at the types of insurance that the reciprocal is writing. We'll look at geographic diversification, where they're writing, and we'll look at, just like we said, the types of policies. So, we look at the overall scope of the operations, and we'll see, again, with regards to the products and with regards to the overall marketplace, we consider, again, what lines they're in and where they're operating geographically within the scope of market conditions at that present time. And so, for the startups, we'll look at how likely they are to be successful in that marketplace in the current time. And as we look at their overall business plan and look at the execution risk, we'll also consider that in terms of what we think or how successful we think they'll be prospectively.
So are you expecting more formations, and are the current ones here for the long term?
So I think we've seen, for the AM Best rated reciprocals, we've seen a number of them that have, kind of started from the ground up and have continued as their operations have continued. They've been able to generate the retained earnings to be able to supplement their balance sheet or supplement their capitalization. So for those that have been successful in terms of generating underwriting and operating profitability, we can see them continuing on. In terms of the number of formations, as Alex mentioned earlier, market dislocation was a big factor in the, let's say, the 2015 to 2024 period in terms of the number of reciprocals that we saw getting formed in that period. A lot of it had to do with states that were having a tough market time from homeowners' perspective. So Florida and Louisiana, where they had a number of years where they were highly impacted by catastrophes, and that caused a lot of the admitted companies writing that line of insurance to kind of rethink their risk appetite and maybe shrunk the overall supply of insurance capacity in that marketplace, and that gave rise or gave the opportunity for some of these reciprocals to form. We've seen the last year and a half, almost now a full 2 years with the end of 2025 in focus now, we've seen the homeowners marketplace stabilize a little bit. So as I look forward and think about your question in terms of whether we'll see additional formations going forward, if we see more market dislocation, whether it's on the homeowner side, private passenger auto side, anything that's affecting any given states or any given regions, we might see market conditions that, again, provide the opportunity for reciprocals to continue being formed. We've also actually seen private equity, in some cases, as they've looked to gain access to the property casualty insurance market, again, provide some of the capital and identify an attorney, in fact, and then use that as the basis, to form a reciprocal formation. So I think also we might see private equity continue to utilize that avenue. And if that were to happen, we might see reciprocal formations coming out of that as well.
Thanks, David. Alex?
You're welcome, John.
Thanks, John.
That was David Blades, Associate Director, Industry Research and Analytics, and Alex Wynant, Associate Analyst. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.